At this point, you should have completed the core case in Practice Lab and compared your work to the answer key. If so, let's do a review. So let's start the process by looking at last year's tax return. We have nothing happening until line 8. There's other income from Schedule 1, so we want to know about that $26,000. There's a reduction in income also from Schedule 1, line 22, so that's going to be interesting. We have a $12,400 deduction. That's got to be a standard deduction, nice round number for a single person. We have qualified business income of $969 deduction. QBI can be as much as 20% of income, so it's obviously less than that. We're going to take a look at that calculation a little bit later. That brings us to taxable income of $38.77, and when we move to page 2, we see that the tax is 10%. This taxpayer is in the 10% marginal tax bracket. So line 23, other taxes, $36.83. That's self-employment tax, as we will see, and that's probably among the most important lines on this page because taxpayers pay 15.3% of their net profit from self-employment, Schedule C. 7.65% of that is the normal Social Security and Medicare payments that any employee would pay, and the other half is the employer's half, the other 7.65%. So 15.3% of self-employment income ends up as taxes, which is something that a lot of taxpayers don't know, or at least they don't know until they've been getting self-employment income for a couple of years. That's a big number. When you're explaining that to the taxpayer, 15% is probably a good rounding factor. The other thing I want to note before we go on is that there's obviously a temptation on the part of self-employed individuals to underreport income if it's not on a 1099 NEC or 1099 miscellaneous, which is not the correct form, but will happen occasionally. That is to not report or not include in income, checks or cash or anything else that the IRS has not been notified by a tax form. And obviously this saves money for the taxpayer because they're not paying that 15.3% self-employment tax. But it also means that the income that's reported to the Social Security Administration, the income that determines to a large extent Social Security benefits when one starts taking those in the 60s, is lower than it otherwise would be. So yes, the taxpayer saves money, saves taxes, by underreporting income. They also impact negatively their future Social Security payments. So continuing on down, line 26, we have $4,400 of estimated payments, which is pretty much spot on. The taxpayer ends up with a small refund. If you're self-employed, since the people who pay you are not going to be doing tax withholding, you need to figure out how to do that, and the standard way to do that is with estimated payments. Presumably, those were $1,100 each quarter, but that doesn't really matter. The taxpayer could have paid less some quarters and more some quarters. The critical thing is by the end of the year, they need to get to a number that's close to what they're going to owe, and they can't backload it. The IRS at least frowns on that, and the IRS is told where the payments go. So it needs to be reasonably smooth through the year. But the IRS will not calculate a penalty if, for example, this taxpayer had paid $1,000, and then, so let's say $1,200 in the 4 quarterly payments. So on to Schedule 1. Here is our $26,000. That's business income, Schedule C. We'll look at that schedule in a little bit. And here are the 2 reductions in income totaling $8,800. One of them is the deductible part of self-employment tax. So although the taxpayer has to pay both 7.65% sides of Social Security and Medicare, half of its deductible. Notice we'll see that this actually doesn't reduce the self-employment taxes, so it may or may not actually help, but at least it reduces regular taxes. And then self-employed health insurance deduction. If the taxpayer has policies that they pay for, then they can take a deduction. We'll talk about that in more detail later. Here's Schedule C, which has $28,000 of income, and then expenses totaling about $2,000, getting down to $26,000. We'll talk about this later as well. This is really useful to compare the Schedule C for the current year versus the Schedule C for the last year and see if you've missed anything. On page 2, cost of goods sold better be no here because this is out of scope. Otherwise, we don't provide tax preparation for people who have inventories. That is, people who track the cost of goods sold and adjust their taxes accordingly based on how that affects their profits. Part 4 is normal. You're going to see this. We basically split the vehicle mileage into 3 categories. That's an interesting process. We'll talk about that when we get to Schedule C. And then anything else that doesn't fit into the categories on page 1 goes here on page 2. So Form 8995 isn't something you normally worry about. This is the QBI deduction, which again can be as much as 20% of the net profit. In this particular case, we saw that the net profit was $26,000, but the calculation here is only calculating it based on 20% of $17,000. That's because that $8,800 consisting of the deduction in half of self-employment taxes and the self-employed health insurance, $8,800, is subtracted first. So those, in some sense, the net profit is after those 2 subtractions. And again, self-employed health insurance is optional. That is, you won't necessarily see it on all returns, although mostly you will when you have self-employment income. So this is the 20% calculation, but notice that it isn't the bottom line. And the reason it's not the bottom line is because there's a second potential reduction. That is taxable income on line 11. So you can't get 20% deducted from taxable income if that 20% of your profits, if you don't have much taxable income. So in fact, the QBI, which we think of typically as 20% of net profit, in this case turns out to be much less. Now, I've shown you this. Generally speaking, you don't worry about QBI. The computer will calculate it, but if for some reason the question comes up about why it's not 20%, and most taxpayers aren't going to be that savvy, then the 1040 points to Form 8995, and you'll find that here, and you can look through that, and probably it's because taxable income is so low. Taxable income is low in this case because the standard deduction reduced adjusted gross income to a lower number. Next, let's take a look at the intake booklet, first couple pages. So quick scan of lines 4 through 11 shows that they're all answered no, which is good. If there were a yes, we'd want to do something about that, probably. On page 2, we're looking at yeses. Self-employment income, that's not surprising. Some expenses related to self-employment. Some estimated tax payments, just like in 2020, and EIP, and as always, you want to ask exactly how much that is. Okay, you've looked at the prior tax return, you've looked at the intake booklet, you've looked at the tax documents, and this is the information that you should have gotten through the interview. Divorced in 2018, you might want to ask you something on the order of, I see you didn't have any alimony, is that correct? She checked no. No dependents, rents a home, and has meticulous records, which is not always the case. So all of this income and expenses are all related to the self-employment, private health insurance, and long-term care insurance are sort of related, but because they can be used as a deduction against income from Schedule C self-employment. That's really this car mileage you're going to have to get. We'll talk about that in a little bit. There's your estimated tax payments, and we're going to enter that shortly. The stimulus payment, of course, you had to ask about. No charitable contribution, so no deduction. So now we've got the information we need from the interview notes, and we're ready to look at what was entered into TaxLayer. So let's take a look at total payments made during tax year 2021. This is pretty straightforward, $1,200 a quarter. Notice that we didn't actually collect the dates from the taxpayer, or the exact dates that these were made, but we don't have the ability to put in the dates that they were paid anyway, so we're kind of fitting them into 4 boxes. If, for example, the taxpayer had not paid around April 18th, but had made 2 payments, or made this first payment close to June 15th, and then the second one, say, the 18th, we would put $2,400 into this box, and this first box, or second box, if you will, would be blank. So we only have to get this approximately right as far as which box the 4 payments in this particular case best represent when the payment was made. The format of the 1099 NEC is a little different than a W-2 or 1099-R in that the payer's TIN, which might be Social Security or an employer identification number, is down here below the address. And as you may have found, when you enter that, it does not populate the payer's name and address, as is the case with the W-2 and 1099-R. Why? Who knows? So you put this information in. This is an interesting point here. Sometimes the payer is an individual. And in that particular case, you would check this box, which would change the format here to be the 3-box Social Security, and you'd enter the Social Security number. Still 9 digits, but in a different format. Moving down, the account number does not have a little red asterisk by it, so it is not required information. I don't think you could get away with not putting anything in box 1, even though it doesn't have a red asterisk. State information is not required unless there's state withholding, which would be extraordinarily rare. After you enter a 1099 NEC and click Continue, this is the screen you're going to see. It'll ask you where that 1099-C goes. If you click Schedule F, you are doing something that's out of scope. We don't do farm income. So in this particular case, you're going to click Schedule C. If there is no Schedule C, when you click that and click Continue, then you will be dumped into a Schedule C to create that. If you've already created a Schedule C, then you're asked another question. Do you want to put this 1099 NEC income on the existing Schedule C, or do you want to create a new one? If you click Report on one that's already been created, it will list the one or ones that you've already created, and you can select that. It doesn't really matter whether you create the 1099 NEC first, enter those, or Schedule C, but you have a little bit more control over your workflow if you create the Schedule C first and then the 1099 NEC. But really it doesn't matter. Just be prepared when you have the 1099 NEC created to be dumped into a Schedule C if one doesn't exist. So let's take a look at Schedule C income. And here's the $35,000 from the 1099 NEC. And here's $900 from the other 2 sources of income. This has just been put in as a total, but as we've seen in another situation, you can also go here and put in the description. First-time author for $500. Click Continue. Add another one. Description is small publishing house for $400. Now we've got both of those, and we click Continue, and the total is $900. We're still in the same place, but we have some detail in case we want to know how we got to the 900. And of course, TaxSlayer adds it up for us. We don't have to worry about that. Notice that we put that in the top line as gross receipts or sales. We don't use the other income. So why wasn't there a 1099 NEC for either of those two smaller payments? Well, first, the payer is not required to generate a 1099 NEC or a 1099 miscellaneous for that matter, unless the total amount is $600 or more, which both of the payments were under. And the second reason is that if you are not in the business of paying or hiring, in this case, copy editors, which that first-time author was not, then you're not required to generate a 1099 NEC regardless of the dollar amount. So it's not surprising that Aline had some income that wasn't on a 1099 NEC, and she did the right thing. She reported it to you, the tax preparer, to enter into TaxSlayer. So let's turn to the expense side. And the first question as you look through expenses is, do they relate to the business or not? LinkedIn, yes, you want to attract potential clients. Professional web page, same thing. Society membership, yes, you might get a lot of useful information about how to run your business. That's obvious. Equipment under $2,500 is allowable. You don't want to depreciate it because that's out of our scope. There's some formulaic information you want to put in. We'll show you how to do that in a moment. Editing software is also relevant. When you have internet service, you want to find out what percentage is from business, and that's an acceptable expense. Cell phone is the same thing, even if there is no home line. Even this is the only cell phone that the taxpayer has, the percentage that's used for business is an allowable expense. And then health insurance and long-term care insurance are related to the self-employed health insurance, and we'll take a look at that separately. We'll also take a look separately at business miles. So let's look in general expenses. That's the one that has pre-established categories. And as you can see by the shaded area here, we've put in some specifics. So there's LinkedIn and web page. Continue. Those could have perhaps been put under the web page could have been put under legal and professional services. Doesn't matter. The IRS doesn't get that level of detail. It's important just to capture the details. Let's talk about health insurance a little bit later, so we'll skip that. Here's some supplies, $300, and here's some utilities. Cell phone and internet can be classified under utilities, or they can be put under other expenses. We'll click Continue. And that's it for general expenses. Click Continue. This brings us back to the main page. Next, let's take a look at other expenses. So here we have 3. These don't fit into one of the categories for general expenses, so we put them into other expenses. The only thing that we need to do besides admire our handiwork is to note that because the computer is a piece of equipment, we are going to have to add something elsewhere in TaxSlayer. So here's what the Duck Book says about equipment. You have to put a statement on the election explanation. Election means you've elected a particular tax treatment. And we're going to go there to miscellaneous forms, statements, elections, and put in this title and text. So we don't need to hit continue or do any of the other stuff. We can just jump directly to miscellaneous forms. Scroll down to explanations, click on begin. There's our explanations. Enter all that information, click continue, and our incantation is done. Not that the IRS is ever going to need this, but if they do, we have dotted that I and crossed that T. Finally, let's take a look at car and truck expenses. You need to put in the vehicle, the date brought into service, and the miles. This is a difficult subject to talk to the taxpayer about often because they don't understand the difference between business miles and commuting miles. Commuting miles is when you go from your home to the customer, or when you come back from the customer or client back to your home. That's why a regular employee cannot, or somebody who's commuting 60 miles a day to San Francisco cannot deduct those miles, claim those as a business expense, is because that's commuting. And of course, other miles are typically personal miles. So what's left? What's left is basically going between clients. So you go to client 1, that's commute miles from home, and then you go to client 2, and that is business miles. And if you go to client 3, that's business miles also. And then when you come back, then it is commute miles. The one exception is that if the taxpayer has a regular place that they commute to, in this case, Eileen clearly does because she's got a main employer, at least if somebody who pays her on a contract employee basis. And if she had to drive outside of the metropolitan area she lived in to go to another client, all of that miles would be business miles. But that's an unusual exception. So let's take a look at that $7,200 of health insurance. The first thing to note is that does not show up on Schedule C. That shows up on Schedule 1 as a separate entry, and we've talked about that already. This has some detail, so we go there and take a look at that. And notice that the long-term care insurance is added in this category. It is subject to a limit. Those are covered in the Duck Book as well as in Pub 4012, page E5. So in this case, the taxpayer is age 40 or under, so she is limited to taking $450 of premiums as part of her self-employment health insurance. And those limits are also in the Duck Book. So here we have just a standard health insurance policy, a little under $7,000. This could be Medicare Part B, Medicare Part D, Medicare Advantage premiums, Medigap policy. All of those are common for somebody 65 and older, and they might have a part-time job. So they have some part-time self-employment, so they have something they can claim the self-employment health insurance for. In fact, that's the first thing you should think about when you see Schedule C self-employment income is there going to be some offsetting self-employment health insurance that you'll want to put onto Schedule C, at least as far as entering it via TaxLay or via Schedule C. In the deductions section under adjustments, there is a self-employed health insurance entry. We do not use that. Policy in the Tax-Aide program is that any self-employed health insurance costs are entered via Schedule C. This concludes the core case. Please pause the video and do the expanded case, tasks 5 through 8. Okay, let's take a look at interesting aspects of the expanded case. The identity protection pin, IP pin, is very straightforward. If you go to the basic section, it's going to be the 4th item on the menu. And notice that you have entries that you could have 2 entries, one for the taxpayer and one for the spouse. Eileen is single, so there's no spouse option. Go in there and look at it. Again, very straightforward. Has a nice link here in case the taxpayer can't remember, can't find the piece of paper that from the IRS that came. So you can click on that. That opens up an IRS page. Probably the last thing I would want to mention about this is really a good subject in which to stick a note. So underneath the taxpayer's name, under notes, we're going to put IP PIN, And we're going to say taxpayer needs to bring IRS letter each year with new IP PIN. And then if there's carry forward information, that is, if the taxpayer comes back to the same site next year, or if the taxpayer signs consent 1 and then goes to any other Tax-Aide or VITA site, then when the carry forward information that comes up when you put in the Social Security number will include the note, which is a good reminder to the tax preparer next year. Alimony received is always income. It may not be federal income, but it is always California income. So it needs to be entered, and it's entered on the federal return, again, regardless of whether it's federal income or not. So alimony received, click Edit here. Not much to put in. The amount of alimony received and the date. Notice that if the agreement's been modified, the divorce decree has been modified, you put the date of the modification, because agreements made prior to December 31st, 2018 involve alimony that is taxable on the federal return, and after that date it is not taxable, and a modification to the divorce decree that affects that could change the taxability. California, again, always taxes alimony. Taxpayer knows that. So this, regardless of what the date here is, it will show up on the California return as taxable. For this 1098-T, we have two options. One of them is we can use this for the lifetime learning credit. And the other is that we can use this as a expense on Schedule C, a business expense, and reduce the amount of self-employment taxes as well as the regular amount of taxes owed. So which should we do? Well, we try both. Education expenses go under other expenses, and so we are able to put these two separate items, the tuition and the 1098-T and the cost of the book. Both of those are allowable under Schedule C. And then we make a note that in the federal return, at this point, playing it this way, the taxpayer owes $897. So we've deleted it from this list. Let's click on Continue and then go to Deductions, Credits menu, Education Credits. We're going to pick the Lifetime Learning Credit. So this information gets filled in based on the 1098-T, and I think I may have mentioned elsewhere, the 2020 1098-T didn't even have Box 2, so this is a bogus question. So the Institute's federal identification number comes from the form. We don't care whether the scholarship opportunity credit has already been claimed. That's actually probably worth asking the taxpayer. Actually, it shouldn't make any difference, because you're going to say the student was not enrolled at least half time, which means the AOC credit can't be given, even if the computer were able to calculate that somehow it was worth more. We click on Continue. So when the return summary is finished spinning, it says the federal tax owed is $937. That's $40 more than if we put these expenses under Schedule C. We're not quite finished, because while we can only put the $414 under the lifetime learning credit, we can put the $120 under Schedule C. In other words, probably should not have erased it. So let's go back to Schedule C and put it in. So now with the $414 is a lifetime learning credit and the $120 as a Schedule C expense, we still don't get to $897. We're at $908 owed. So again, very small difference between the two options. But the important thing is that expenses that don't qualify for the education credit can go here. So we've tested how to use the education expenses both ways. Schedule C wins, at least in the short term, although it will reduce the amount of Social Security benefits potentially that the taxpayer will get because they're reporting less net profit, and net profit is income that counts towards Social Security earnings. So pretty close still. Before we delete this lifetime learning credit, because we're going to put this $414 on the Schedule C, one final note. If we had left this here, or had a totally different set of circumstances, if we had left this here, we would have needed to make a manual adjustment on the California return to decrease income, because California doesn't recognize the use of expenses for lifetime learning, just like they don't recognize the use of expenses for the AOC. And so those expenses can be used elsewhere on the California return. Now, a lot of times there is no, probably most of the time, there is no Schedule C, or what was taken isn't related to the business, and so you can't move it to a Schedule C. But sometimes you can. So again, if this had worked out to the advantage of the taxpayer, that we wanted to put this expense on lifetime learning, we would need to make a manual adjustment on the California return to use that $414 on the California return to reduce California income. For estimated taxes, the total tax owed for 2021 was $5,600 and change. So we're providing the taxpayer with these 4 estimated quarterly payments that will total $5,600 and leave the taxpayer owing less than $100. It's always a good idea to point out to the taxpayer that these numbers are not cast in concrete, that the fact that they have a voucher that says they should send in $1,400 does not mean that they should send in $1,400. If their income is less, they should send in less. And if their income is more, they should send in more. And if it's going to cause them hardship to send in $1,400, even though that's about what they owe, they should send in less. And then hopefully catch up in the second or third or fourth quarters. And if not, be prepared to owe money when they file their taxes. If they want to change the voucher, all they need to do is line through the dollar amount and write the new dollar amount of the check that they are sending. And I think we mentioned earlier, you also have the possibility of paying through other ways. This estimated payments tends to be for older taxpayers, but older taxpayers also know how to go online and do things, so it never hurts to mention that they can also pay online if they want. Question 1. What if Eileen had $78 of expenses for business meals eaten in restaurants? Could she claim this as a self-employment expense? So business meals can be claimed. As it mentions here on page D-20, any business expense must be ordinary and necessary, one that's common and accepted in the industry. So it might be common in the published industry for a copy editor to go out to lunch with a client, for example, that first-time author that Eileen is doing some work for. It might be common or normal to have to go out for lunch if your publishing company that employs you as a copy editor on a contract basis wants you to come for some meetings before and after lunch, and that's not convenient for you to go home. You might go out to a restaurant with your contact at the publishing company. So all of those are okay for business expenses as long as the expenses are not extravagant. If you have a $200 meal, that's extravagant. If we look at TaxSlayer, on the general expenses page, it's got meals down here, 50%, 80%, 100%. Those percentages are from 2020, and it's not clear that the 80% actually continues to apply. 100%, this year, Those percentages, 50, 80, and 100, are from 2020, and generally speaking, you would put your clients' meals into the taxpayers' meals into the 50% category. So it's possible we'll get some guidance later on that this will change. But if it doesn't, my recommendation would be to put the business meals into the 100% category, since again, that's what's relevant in 2021 and 2022. Question 2. What if Eileen received her healthcare insurance through the California marketplace, that is, through Covered California? How would this affect her tax return? The problem is here, the problem that makes this, unfortunately, formally, officially out of scope, is that the amount that she pays for healthcare insurance reduces her AGI. The amount of the AGI affects the premium tax credit she's entitled to, including how much she may have to repay. And that, in turn, affects the health insurance. And so we have this circularity here where one goes up, which pushes the other down, which pushes the other up. There are some workarounds. This is something that the local coordinator would need to get involved in. And if the local coordinator isn't willing to do a workaround, then this becomes out of scope, and the taxpayer, unfortunately, is going to have to go to a paid tax preparer or use tax software, which at least as a couple of years ago didn't handle this very well. Question 3. What if Eileen's coursework was from a source that was not an institution recognized by the IRS as accredited, did not participate in the student aid program? Then Eileen could not take this as a lifetime learning credit. She could, however, still use it as a business-related expense. So lack of accreditation is not a fatal flaw, but it is a limiting factor. This concludes case number 6, Fontanilla, and you are ready for case number 7.